Thank you, Mr. Chairman. Dr. Pivovart, when I graduated from high school in 1980, the Dow Jones Industrial Average had a low that year of 759, and it traded at a high of about 1,000. Last time I checked this morning, the Dow was at 32,000. And I guess my question for you is, if a retail investor took whatever amount of savings he or she could and regularly invested in a broadly diversified portfolio through whichever mechanism, and did that over these last 40 years, is it likely that that investor would have earned very substantial returns on those investments? Or is it more accurate to think of the stock market as a zero-sum casino where that middle-income American is going to lose because there's a hedge fund out there somewhere that wins?
Yeah, thank you for that question, Senator. As Andy Vollmer pointed out in his testimony, the returns that retail investors get from long-term investing is exactly the same as an institutional investor who invests in the exact same securities. And what we know for long holding periods is that, on average, the stock market tends to go up. There are daily fluctuations, there are minute-by-minute fluctuations in individual securities, but what we know is that retail investors who hold diversified positions in low-cost mutual funds and other mechanisms over long periods of time will do quite well in increasing their wealth.
And those low-cost options are lower in cost and more available today than ever before. Isn't that true?
That is correct. Since the time that you graduated in 1980, not only do investors have the opportunity to invest in open-end mutual funds, but a new innovation, exchange-traded funds, has entered the landscape and has brought incredible competition to this industry and brought fees and expenses to their lowest rates in history.
Right. A quick follow-up on the faster settlement cycle. I understood you to say that there might be some challenges, technical challenges in real-time settlement. But would you distinguish between real-time settlement and same-day settlement? And do you think that it is feasible to move to same-day settlement, or do you think we really should be happy with T+1 rather than the T+2 we have today?
Thank you for that question. I think, first of all, I think what the SEC should do, which is what we did when we evaluated moving from T+3 to figure out should we go to 2 to 1 or real-time settlement, was we took a look at the way the world existed in terms of the markets and technologies 4 years ago, and we said, let's look at it on a cost-benefit analysis. And we said, all right, well, in terms of moving from 3, do we get any benefits, and what are the costs from going to 2 to 1 or real-time settlement? At that time, 2 was the clear winner. What we heard from the industry was that the cost would be low. It would be pretty much speeding up existing back office products. And we heard from buy side, sell side, the clearinghouse, exchanges, even retail investor brokers and securities traders. Moving to 1 had additional challenges. Not only the costs were higher, but as I mentioned in my answer to Chairman Brown, you have to get the bank regulators involved to make sure that all the bank payment systems also line up so that you make sure that these settle correctly. Moving to 0, at that time, whenever we asked people, say, well, how do you get to real-time settlement? And the answer was always blockchain. And we said, well, can you explain how that works? And they would just repeat back louder, blockchain. And so we may get to a point where blockchain technology or digital ledger technology gets us to a point where we can achieve real-time settlement, but I don't think we're there just yet. That's just my opinion. What I think the SEC should do is put out for public comment a rule proposal proposing to move to a shorter trade settlement cycle and put it out for public comment and evaluate the costs and benefits.
Thanks. And Mr. Chairman, if I have time for one more quick question. Yeah, Mr. Vollmer, recently the CEO of Robinhood testified that the restrictions that they imposed on purchasing GameStop and a few other stocks were driven by margin requirements required by the DTCC and compliance with the SEC's capital rule. So 2 questions. One, is that a plausible explanation for the restrictions they put in place? And 2, is it really optimal to have the opacity about how those capital rules work that prevent us from knowing clearly in advance exactly what they are?
Thank you, Senator Toomey. I think the explanation that I heard from the CEO sounded reasonable. The collateral call from DTCC was sudden and in a large amount. That took Robinhood by surprise and caused them to impose trading restrictions. By the way, the trading restrictions were only one way, only on buys, not on sells. So customers could sell. They entered into discussions. They talked to DTCC. They reduced the collateral call because they had imposed these trading restrictions. The SEC is in a position to look at these areas to see if the process could be improved and smoothed, because I agree with theme in your question, and that is, I don't think either Robinhood or the customers should have been taken by surprise quite as much as they were. And if there's a way that we could smooth that out, I think that would be better for the broker dealers and better for the markets.
Thank you very much. Thank you, Mr. Chairman.